Good afternoon, Mr. Cartier. We are the accountants of Team 2, the ones that you have hired to look at both the qualitative and quantitative information about Dowling Mountain Ski Resort, and we are here today with our presentation on our findings. Our agenda for today will go as follows. We will take a look at the SWOT analysis of your company, and then we will lead into issues that we have identified, as well as our recommendations on how to rectify these issues, and finally, our conclusion.
So the SWOT analysis for your company at this time is the strengths would be your location. You are located so close to Syracuse, and this gives you the opportunity to have a close relationship with the local businesses and suppliers. Weaknesses would be not taking full advantage of all revenue streams that are available, as well as there are some large expense accounts such as the telephone bill that we see as a little bit large for your operations. Opportunities would be expanding into providing summer adventures for customers, as well as partnering with neighboring ski hills to provide package deals to increase the volume of customers coming to the ski hill. Threats would be the competitive pressures to keep pricing low because the industry is so competitive and there are ski hills close. To increase revenue, you can't just rely on increasing prices, you have to rely on increasing the volume of attendance. As well, there are the neighboring ski hills close to you, so you have to differentiate yourself apart from these ski hills.
In terms of the issues that we want to take a look at today, the major issue you yourself have identified is the fact that Dowling Mountain Ski Resort right now is not a profitable company. Other issues or minor issues that we have come up with that support this is the fact that their financial statements, their reliability are currently in question. The biggest one that tipped us off was that your long-term debt has been classified as a short-term debt in both 2009 and 2010. As well, on top of that, we'll take a look at management decision-making and the profitability of each division as you have requested. First off, we'd like to take a look at the comparative income statements that you've given us and increases in certain expense accounts. We've taken 20% as our benchmark for accounts which we would like to flag for you to take a look at, and the ones are as follows. Most of them, though, are way beyond a 20% increase. All the ones on the board right now are over 100%, which accounts to a 20% in total expense increase, which when you compare it to only a 9% increase in revenue is quite worrying. The two big ones that we want to show you right now is the interest and bank charges, which have increased over 600% and which have increased in dollar value over $220,000. As well, the other one that we want to look at is repairs and maintenance, which have costed an extra $113,000 for the year. As well, there are other expense accounts, as my partner has said earlier, that are in question, which is one, the telephone expenses, which are at $26,000, which seems unusually high for a company of your size. And the other one, which is the professional fees, which when you compare it to a total amount of $15,000 is unusually high as well. We haven't found where these have been coming from, and we suggest that you take a second look at these. The other thing that we did is compare your company's earnings to that of different ski resorts in the industry. Company B and C are both at opposite ends of the spectrum. Company B is a very large company, whereas Company C is a very small company in terms of skiers that visit them, as well as in terms of the price or revenue that they receive per visit. They're on opposite ends of the spectrum. Company B makes a lot more than Company C in terms of revenue per visit. But the one thing that they do have in common is the fact that they are both profitable, which leads to the idea that we ourselves as Dowling Mountain Ski Resort should be profitable as well. The one thing that we've isolated as making a huge difference is our labor to revenue ratio. If you take a look, Company B has a 39% labor to revenue ratio, even though they are a larger company than us, and Company C has a 30%. So if we were to do a conservative estimate and put our labor to revenue ratio as 39% instead of 43%, we would be able to save over $120,000 a year. If we were more liberal in our estimate and what our labor to revenue ratio should be, it would be about 37%, which would also mean that you could save about $200,000 per year in expenses. And this all comes down to management decision on how expenses are allocated and how those will be tracked in your company.
All right, so looking at cash flow, you have a positive cash flow from operations, which is optimistic for any company. As well, you have negative cash flow from investing activities, which is status quo with most companies who continually acquire capital assets. Cash flow from financing activities is a quite large number in the negative values. This isn't always a bad sign if a company is using this money to pay back long-term debt and to reduce that value. But of this negative number, only 1/3 of it is used towards paying down long-term debt. 2/3 is actually that investment capital has been removed from the company. As you can see, this has left you in a cash flow position of having zero cash. So if that investment capital had not been removed from the company, it would have left you with positive cash, with a positive cash balance, which would have potentially encouraged Lazario Steel to acquire the naming rights of Drawling Mountain Ski Resort, and that could have led to a positive impact on the balance sheet. So you have also asked us to look at the profitability of each division. So we have done an analysis, and looking at the gross profit margin, the only one that is not making a profit is the ski hill, which in this industry you can't really discontinue the use of the ski hill. So we have to look at different variables. So we took into account the percentage of labor to revenue. Again, we find labor is a very large expense that we need to control. So there are some divisions such as rentals and hotels that do have a larger percent of labor to revenue, but this is matched by a fairly high gross profit margin. So they're able to support the labor that they're using. Whereas the ski hill has by far the highest percent of labor to revenue, and they're not able to support that with the revenue that they're making. So if we're able to decrease the labor used on the ski hill, this will increase the gross profit margin, and then it can be supported by the revenue streams from the other departments. The recommendations we have are to decrease expenses. So number one is decrease labor expense, which we have gone over a few times in this presentation. Number two would be reconsider what is classified as an expense. So looking back at the telephone bill and the professional fees and seeing if we can bring those expenses down to reasonable values for your company. As well, we want to increase revenue. So if we do partner with the neighboring ski hills, we can offer the package deals and we can increase the volume of attendance during the winter months, which will help us increase revenue. As well, if you expand into the summer activities and provide activities such as hiking and mountain biking, this can increase revenue because you're opening up your park and it's being run with less labor than is required in the winter months.
In conclusion, we would like to say that from our analysis of both the industry and from your financial statements, that Drawling Mountain Ski Resort can be a profitable ski resort if the suggestions that we have given you are implemented. And so we believe that that is the direction that you should go at this time. If you have any questions, please ask us.